Okay, I need you to imagine something. You're standing in line at Chipotle. You order a burrito. You add guacamole because at this point you've already made several questionable financial decisions. Maybe a drink, maybe chips. The cashier tells you the total is $20. And then you say, "Actually, I'd like to finance this." Not as a joke, not ironically. You genuinely want to pay for your burrito in 4 installments. Now, if you had said that 10 years ago, somebody would have checked if you were okay. Today, that's a business model, and not a small one. According to the Federal Reserve, buy now, pay later providers issued close to $157 billion worth of credit in 2025 alone. $157 billion. And here's the part that really broke my brain. More than 60% of that carried 0 interest, which means millions of people don't experience buy now, pay later as debt. They experience it as a feature, a convenience, a life hack, which immediately raised a question that I became mildly obsessed with. If consumers aren't paying interest, then who exactly is making all the money? And that's when I discovered something that honestly sounded fake. In 2025, DoorDash partnered with Klarna, which means you can now finance your food delivery, your late-night burrito order, your emotional support chicken wings, your poor decisions. And apparently, hedge funds and Wall Street investors are increasingly interested in buying that debt. So naturally, I spent several weeks trying to answer what I believe is a perfectly reasonable question. Who looked at a burrito and decided it should become an investment? How did we start financing burritos? Let's do a quick experiment. Suppose I offer you 2 choices. Option A, pay $20 for this burrito right now. Option B, pay $5 today, then $5 later, then $5 after that, then another $5. Now, mathematically, and I checked this multiple times because I didn't trust myself, those options are identical. Psychologically, they're not even close. Because if you're like most people, option B feels cheaper. Not because you're bad at math, because you're human. And this is where I realized that buy now, pay later companies did something genuinely brilliant. Companies like Klarna, Affirm, Afterpay, and PayPal didn't invent debt. Debt is ancient. The Babylonians had debt. The Romans had debt. I have debt. What buy now, pay later companies invented was something much more valuable. They invented debt that doesn't feel like debt. Instead of saying, "You owe us $20, they say, "You only owe us $5 today." And apparently, that tiny psychological adjustment was enough to change consumer behavior on a massive scale. By 2023, more than 53 million Americans had used buy now, pay later. That's roughly 1 out of every 6 people in the United States. Warren Buffett once said, "Chains of habit are too light to be felt until they're too heavy to be broken." And I think that's what makes buy now, pay later so fascinating. Nobody wakes up and says, "You know what? I'd really like to become financially overextended today." They just wanted a burrito. The psychological trap. At this point, I thought, okay, people just like flexibility. Then, I started reading behavioral economics research, and honestly, things got weird. Behavioral economists have a term called mental accounting, which sounds incredibly boring, but it turns out to explain an astonishing amount of human behavior. The idea is simple. Human beings don't treat money like money. We treat money like feelings. For example, a $200 jacket feels expensive, but 4 payments of $50, that feels manageable, even though those numbers are literally the same. And then, I found the statistic that made me sit up straight. Researchers discovered that when buy now, pay later is available, people don't just spend more, they spend a lot more. Some retailers reported increases in basket sizes of 20% to 60%, not 2%, not 6%, up to 60%, which means one of two things happened. Either consumers suddenly became wealthier the moment they saw a payment plan, or buy now, pay later changed how our brains experience spending. And according to Nobel Prize-winning psychologist Daniel Kahneman, that's exactly what happened. Kahneman spent decades proving something that is honestly a little embarrassing. Human beings don't make rational decisions first. We make emotional decisions. Then we invent rational explanations afterward. Which means that when someone says, "I'm not spending $200, I'm only spending $50 today," they're not doing math, they're doing psychology. And honestly, buy now, pay later may be one of the most sophisticated commercial applications of behavioral science ever created. Why retailers became addicted. At this point, I thought I knew who the customer was, the consumer. I was wrong, because the people who really love buy now, pay later are retailers. And honestly, that should have been my first warning sign, because businesses rarely adopt financial innovations because they're helpful. They adopt them because they make money. And buy now, pay later makes retailers a shocking amount of money. Imagine somebody walks into your office and says, "I've invented a button. When customers click it, they voluntarily spend 20 to 60% more money." You don't ask questions. You install the button immediately, which is exactly what happened. Amazon installed the button. Walmart installed the button. Shopify installed the button. DoorDash installed the button. Apparently, Civilization installed the button. And here's what really surprised me. Merchants willingly pay buy now, pay later companies fees between 2 and 7%, often more than they pay credit card companies. Why? Then I remembered Charlie Munger. Show me the incentive and I'll show you the outcome. If paying a 4% fee makes your customers spend 30% more money, that's not a fee, that's an investment. And suddenly I realized something uncomfortable. Maybe buy now, pay later wasn't designed to help consumers spend responsibly. Maybe it was designed to help businesses sell irresponsibly. Burrito status report. At this point, my burrito was no longer food, a psychological experiment, a retailer growth strategy, and unfortunately, things were about to get significantly stranger. The billion-dollar business of free money. At this point, I thought, okay, retailers are the winners. Then I looked at Klarna's numbers and immediately became confused again, because Klarna isn't some tiny startup exploiting a loophole. Klarna is enormous. The company serves around 119 million users worldwide, which means a Swedish fintech company has more users than many countries have citizens. By early 2026, Klarna generated over $1 billion in quarterly revenue. Meanwhile, Affirm processed $36.7 billion in 1 year alone, which raised another question. Wait, if consumers aren't paying interest, then where is all this money coming from? The answer is everywhere. Merchant fees, interest income, late fees, advertising, data, but most importantly, assets. Because buy now, pay later companies aren't just lending money, they're manufacturing something. And once I realized that, everything else started to make sense. Burrito status report. My burrito was now a psychological experiment, a retailer profit machine, a billion-dollar business model, still technically lunch. How your burrito becomes a Wall Street asset. This is the point where I genuinely thought I had misunderstood something. Suppose I buy a burrito. Klarna pays Chipotle. I owe Klarna. Simple. Except, Klarna doesn't necessarily want to keep my debt, which raised a question that I think is objectively reasonable. If Klarna doesn't want my burrito debt, who does? The answer is Wall Street, and not metaphorically, literally. Here's what happens. I buy a burrito, a loan gets created. Then, my loan gets thrown into a giant pile with millions of other loans. Burritos, groceries, shoes, concert tickets, vacations, medical bills. Then Wall Street takes this giant pile and puts it into something called a special purpose vehicle, which sounds like a spaceship, but is actually just a giant financial box. And that box creates securities, investments, assets, bonds, which means that somewhere along the way, my lunch became an investment product. And before you think I'm exaggerating, BNPL providers issued close to $157 billion of credit in 2025. Private equity firms like KKR have already bought these loan portfolios, which means there may genuinely be somebody sitting in Manhattan whose annual bonus depends partly on whether I pay for my burrito, which honestly feels unfair. Burrito status report. My burrito was now food, psychology, retail strategy, financial product, potential hedge fund exposure. Things had escalated. Why Wall Street loves your debt. At first, I found this hilarious. Then I realized Wall Street wasn't laughing, because Wall Street doesn't see burritos. Wall Street sees repayment probability, default rates, yield, securitization, cash flow. To us, burritos. To Wall Street, chart. And apparently, it's a very attractive chart. Some of these securities generate returns of 6 to 8%, which suddenly made Nassim Taleb's observation feel less like philosophy and more like a business model. Banks, like sharks, must keep moving to survive. Modern finance survives by finding new things to turn into assets. Houses became assets. Cars became assets. Student loans became assets. Credit cards became assets. And now, apparently, our burritos have become assets. And that's when I realized I'd been asking the wrong question. The question isn't, why is Wall Street buying buy now, pay later debt? The question is, why wouldn't it? Because Wall Street didn't discover a payment system, it discovered a machine. A machine that converts one of the most predictable forces in human history, human impatience, into an investment product. Then I found the statistic that bothered me more than any other. 41% of buy now, pay later users reported missing at least one payment, and around 25% reported using buy now, pay later to buy groceries. Groceries. Not luxury watches, not designer handbags, groceries. And that's when I stopped thinking about the burrito, because this story was never really about burritos, or Klarna, or Wall Street. It was about a discovery. The discovery that human behavior itself can become an asset. That if you can predict what millions of people want and convince them to borrow against those desires, you don't just have customers, you have a financial product. And maybe Wall Street isn't betting on buy now, pay later. Maybe Wall Street is betting on something much more reliable, the fact that human beings have always wanted things now and have always believed they'd figure out how to pay for them later. And honestly, that might be the safest investment Wall Street has ever found.